Coming up in this episode, CPI comes in a little lower than expected at an annualized rate of 4%. Core CPI is still running above 5%. Goldman Sachs raises its price target on the SP 500. NVDA finishes with a market cap above 1 trillion. China cuts rates, and the Tesla rip continues. Welcome back to Click Capital, everybody. I hope you're having a great Tuesday. And so the CPI was expected at 4.1%, came in a touch lower at 4%. However, the Fed's preferred measure of inflation, core inflation, came in as expected at 5.3%. And here's a breakdown of the inflation numbers by category. And these are the year-over-year changes. So we can see down the bottom we've got health insurance coming off 20% year-over-year. But apart from that, a lot of the items that did come off are a bit more on the discretionary side. We can see that in airline fares, car and truck rental, televisions, major appliances, and used cars. And up the top is a bit more on the essential side. So motor vehicle repair, insurance, pet food, frozen fruits, household paper products, medical equipment, supplies, and rent. So the stuff that people need is still well and truly really inflationary. And the Fed itself says it prefers to measure inflation by looking at core CPI, which is still well above their target of 2% and still running above 5%, coming in as expected today at 5.3%. And here's a 10-year chart of the core CPI year-over-year change. So we can see for much of the past decade, it has been running under their target of 2%. We went a little bit above here in March 2016 and again in mid 2018. And then we initially had a little bit of deflation going into COVID. However, once the Fed absolutely flooded the system with liquidity and the government as well with stimulus, exacerbating that was supply chain problems, causing a lot of issues on the supply side, and all of that caused inflation to rip up to 6.6% on the core CPI in October last year. So we've only come off a little bit since then, and you can see we're still elevated and still well and truly above where we've been for most of the past decade, and where the Fed wants inflation, because inflation is the biggest threat to society as a whole. And so there's still some work to do to get this number well back down under 3 and towards 2 where they want it. However, the market's convinced that the Fed is going to go on pause tomorrow, and we can see that with another rally across the board here today. Only a few red spots out there with Apple coming off a little bit. But we did see big moves up again in NVDA and Tesla. Netflix is still performing well. And the defensive sectors, utility and consumer defensive and healthcare, continue to trade a little weak. And we recently just had Goldman Sachs raise its price target for the SP 500 this year. On the back of the AI boom, they've now got 4,500 as their target for this year. And I wonder how many people look at this stuff and they say, well, Goldman Sachs says it's going up to 4,500. I best buy and get in now before I miss the rest of the rally this year. However, let's have a look at the last 2 years of SP 500 price targets given by Goldman Sachs. So back in November 2021, when we were sitting around 4,700 on the SP 500, they raised the target for the rest of the year to 5,100, which we didn't hit. Then in February, they cut their price target for 2022 to 4,900 up here, which we didn't hit. In March, they cut it again to 4,700 up here, which we never hit. In May, they cut it again to 4,300, which we briefly hit in August before falling almost 800 points. Then in September, they're like, okay, the market's pretty bad. We'll cut it all the way down to 3,600 down here, which we briefly hit and bounced off. And that's been the low for the last 9 months. Then in February this year, they raised the price target to 4,000, which we briefly went below. And then, of course, we've ripped above it. And now that we've ripped, they've raised the price target to 4,500 for the end of this year. So traders and investors that have been following Goldman Sachs price targets over the last couple of years haven't done very well, and you're better off going in the opposite direction of what Goldman Sachs says the S&P 500 will finish the year at. And one of the big reasons they raised their target is the AI boom, and that's led by none other than NVDA, which closed above 1 trillion in market cap for the first time this year. And just looking at the chart on NVDA, it does look bullish here. We had another big volume day, 61 million shares, closed up, finished near the highs. And for those of you watching the channel, you know I last added to my short position at 414. And because of this bullish price action, I did trim my short position this morning in NVIDIA, and I've actually replaced it with 2 new shorts and increased my short exposure in the overall portfolio from 60 to 80% net short too, as I think the market's really overbought up here. And here's a screenshot from my brokerage account today. You can see I sold short Apple at 183, Microsoft at 333, and Royal Caribbean Cruises I added to my short position, like I said I would, at 96.37. So I know I've been saying I've been shying away from shorting the mega cap techs as they've been on quite the run. However, I think these reversal candles here might play out. And just looking at the weekly chart on Apple, we're really extended up here in this resistance zone. Similar story with Microsoft as well. It looks to be stalling out a little bit at its resistance zone here. and I still think these reversal candles could play out. On a day like today where the whole market was up pretty big, Apple actually finished down a little bit. And just looking at Royal Caribbean Cruises as well, I added to my short at this one today like I just showed you at 96.37, as we're right in the middle of this resistance zone here that we last saw in early mid 2021, and I think this is just a great recession hedge in my portfolio, and I think it's super technically and fundamentally overvalued. And why I trimmed my NVIDIA short is that it looks like the AI hype is not over yet. Look at the moves we got in the meme space today with C3 AI up 14%, Big Bear AI up 12%, and some of the other meme stocks as well. We've got GameStop up over 10%, Carvana up over 10%, Beyond Meat up over 12%. So a lot of the meme stock buyers are getting excited here. And just looking at that price action in NVIDIA, it looks like we could run higher into the 400s. So again, I plan on sticking with my Apple and Microsoft and Royal Caribbean shorts for some time and looking for the big correction in these stocks back down when the market does eventually correct, and if we do get the recession later this year, they could potentially come crashing down from these elevated levels. The other big mover today was Tesla, up another 3.5% in this huge run up we've had over the last couple of months. I mean, it was only in April we're at 150 a share. We've ripped up over 100 points in less than 2 months. And for those of you who watch the channel, you know I'm a long-term permanent holder in Tesla. I hold a core position in it and look to buy the dips and sell the rips. And because we're so overextended here today, I trimmed my position today a little bit in it. I last shared with you guys on the channel that I added to it at 200 a share, and I may look to re-add when we get that pullback eventually. However, as it stands right now, we're super overextended in the short term, but I do think it's been playing a bit of a catch-up with the rest of the market as it had been beaten down a bit more. We got news today that AMD came out with a new AI chip to challenge NVIDIA's dominance. However, the market didn't seem to buy it. We put on a big bearish engulfing candlestick pattern on volume in AMD today. After it initially opened at highs and went up a little bit, the sellers came in with force and took over here from what's already really elevated levels. However, we'll come back to the charts in a bit. I'll just take you through the rest of the news and data out today. So we know Chinese economy has been slowing. COVID opening bump has kind of come off a bit now. And so they just cut their interest rates down to 1.9% and are looking at a big stimulus package to try and revamp the world's second largest economy. And just looking at the Chinese ETF, FXI, we closed up a little bit today, 1.1%. Nothing too exciting in price action there. It was still in a downtrend. However, I do think that news helped the crude oil market today. We bumped up here 2.8% to just under $70 a barrel, as the commodity market's hoping the Chinese market starts slowing down a little less aggressively than it has been. And so the Fed Fund futures market's pretty much saying it's a done deal with tomorrow, with the Fed is going to pause on their interest rate decision due out at 1 p.m. Eastern time tomorrow. Market's saying there's 93% chance they will pause and only a small chance they will hike. And if there was ever time for a rug pull in the markets, it is this week, because we've got the fear and greed index super elevated here at 80 points. And that's largely due to we've just got one of the most bullish, optimistic option markets I've ever seen. Here for a Tuesday, which is normally a quiet day, came in at a whopping 43 million contracts changing hands, and a huge 60% of the volume was in calls. And once again, people just loading into mega cap tech. Tesla 38%, put percentage, NVIDIA 36%, Apple super low 33%. And of course, that's sucking in a lot of retail traders with all this super optimistic price action and media headlines. And that's illustrated best by the positioning of IG market clients in stocks like Apple. And for those of you who don't know, IG Markets is a CFD broker. And basically that means they're just a casino in the market. When you trade with them, you don't actually own the stock. You just have an agreement with them that relates exactly to your opening and closing position. So basically, when you win, they lose. When you lose, they win. Very similar to how a casino operates. And since clients just chronically lose money with CFD providers, the governments actually make them say in all their content how many of their clients actually lose money. So on their own website, they've got it here, 72% of retail client accounts lose money when trading CFDs. So most of the time they're on the wrong side of the move, and we can see here in Apple 82% of client accounts are long. In Microsoft 73% of client accounts are long, and Royal Caribbean Cruises, which I'm short as well, 76% of IG market clients are long. And so IG is basically one of the biggest CFD brokers in the world, I think, if not the biggest, with about over 200,000 clients. And like they say on their own website, 72% of them lose money. Dark index traders pulled back a little bit today with a DIX slightly above neutral territory, and corporate insiders continue to sell stock at a ratio of about 2 to 1. Okay, back into the charts. So we've got the SP 500 closed at 43.69, its highest level all year, and we're super overbought here. We can see the entire candles above our buy sell band and wave flow indicator. And look at our S&P 500 oscillator. We've got a huge 62 reading on it, indicating the market is really overbought. And we can see that in the put-call ratio as well, finishing the day super low at 0.67. So that's a lot of the market, especially retail, absolutely loading into calls and mega cap tech. And once again, nothing against retail investors. I'm one of them myself, and you probably are too. However, looking through history, just retail sentiment makes for a good contrarian indicator. And that's because most retail traders just follow what they see in the news and media and online. Got the NASDAQ today putting in a little spinning doji and a bit better performance out of the small caps. International indices all finding their footing as well here, with the Nikkei continuing to rip higher. Got the VIX one-day index up at 17, anticipating the Fed end decision tomorrow, and the normal VIX 30-day at 14.6. And like I said, if there was ever a time for a rug pull in the market, tomorrow is the day with the Fed decision. No matter what they say, even if they pause it, we could still get a rug pull. And especially if we get that surprise hike, which I still think is a possibility. Because why not? We've still got core inflation at 5.3%, unemployment rates 3.7%, NASDAQ, S&P 500 ripping up. Jay's got every reason to throw another hike in there and front load it instead of just waiting till next month. However, we have a huge option expiry this Friday with quadruple witching. That means we've got quarterly options expiring as well. Things can get really spicy and busy on that Friday afternoon. So maybe after option dealers have offloaded a lot of worthless contracts and they can reposition themselves, maybe we get the dump Friday afternoon or Monday morning after OPEX. Either way, I think the market is primed for a rug pull here, and that's why I increased my net short position in my swing trading portfolio to net 80% short by adding those Apple and Microsoft shorts in there, as well as topping up on my Royal Caribbean short. Short-term breadth as well is at levels typically associated with short-term tops. We've got 82% of stocks above their 20-day average. Growth versus defensive sectors found a new high today, versus value spread stalled out a bit. And there's that small cap versus large cap spread I've been watching and still looking for a bottom on. I still think small caps could outperform here after they've been hit hard the last couple of months. And so interesting today is the headline CPI number came in a little softer than expected. I mean, we were expecting 4.1, it came in at 4. And so the market as a whole is saying like, okay, the Fed is going to pause now. Everything is good. We're going back into this Goldilocks period of low inflation, good growth, AI and all that. However, we actually got a move up in inflation expectations today, as measured by the spread in inflation-protected treasuries versus the regular 7-10-year treasury ETF IEF. And that did a bit of a bullish engulfing pattern as we opened lower and finished higher above yesterday's high. And that's further shown in the price action in the government bond 2-year yield as well. So typically the 2-year yield is really sensitive to what the Fed is doing since it's a short-term bond. And that today had a bit of a bullish candlestick pattern, a bit of an engulfing pattern on yesterday's candle, and actually got up to 4.7% today. And that's the highest it's been in a couple of months. And going back to those levels where we're at just before the Silicon Valley Bank crisis hit, and the market totally repriced the Fed and said they're absolutely done, they're never going to raise. Again, we're at the end of the cycle, we're going to cut now. And as we can see in the price action in the banks, that theory has kind of subsided and cooled off a bit. And then we've got some pretty strong price action in the 2-year yield here. Same with the 10-year yield as well, holding near multi-month highs. And even though we got that down move in the June contract, and that's the market saying that the Fed is probably going to pause tomorrow. They're assigning 93% chance that they are going to pause. Price action in the September contract wasn't so sure. And more so again in the December contract, where it actually crept higher to 521. So the market's saying, whilst we may pause tomorrow, they're not going to be cutting rates anytime soon, and they're going to keep jacking rates high to get on top of inflation. Got the dollar continuing its pullback down to 103.30. Got Bitcoin trading weak as well, and a bit of a bear flag here at 25,800. Commodity complex bouncing back here today with crude. And we got the main DBC ETF reclaiming this huge support zone we're watching. And there's a look at the AI ETF bots climbing up today, 1.7% on good volume, climbing more in after hours as I speak. And this is looking like a bit of a melt up pattern. That's why I trimmed my NVDA short today, as who knows how crazy and high this thing could get. And the winning sector ETF today was PBW, the clean energy ETF, up 3.7%. My regular viewers know that I'm a long-term holder in this fund, and I shared with you guys I added to this position back in late May at $36 a unit, and it looks like we're breaking out today after we've been beaten down for quite a few months now. And there's a look at the weekly chart of the semiconductor ETF coming up to this big resistance zone where it last stalled out in late 2021. Got another nice little move up in the regional bank ETF today. We've got the industrial ETF coming up to all-time highs in this big resistance zone from late 21 as well. And there's a look at the weekly chart of the real estate ETF, still in a downtrend and doesn't look to be getting excited by the prospect of lower rates anytime soon. And there's the weekly charts of the healthcare, staples, and utilities ETFs, all kind of tracking sideways here. Got the BlackRock barometer continuing to tick up, but still overall weaker than the market this year. JP Morgan as well continues to sneak higher, consolidate, and move up after this powerful earnings gap. There's another look at Tesla, and we continue to move higher, now trading at $260 a share after hours. So the market's got really excited how they partnered with GM and Ford. Basically, GM and Ford just jumping on the back of Tesla to use their supercharger network for their drivers. And the market might be getting a little bit excited with the potential release of the Cybertruck in the next couple of months. And I think it's been playing a bit of catch up as well with the rest of the market. There's a quick look at Carl Icahn stock coming up and touching the 50-day VWAP for the first time in over a month here today. And the banks continue to move a little bit higher today as well, with Charles Schwab up 1.45%. Okay, back to the S&P 500 now, just looking at the global net liquidity model, which is the measure of central bank liquidity in the system. We've got an almost huge 600-point bearish gap between that. And we can see the market's just super overbought up here, technically speaking. And I'm still convinced we're at or very near a short-term top in the market. It would be very unusual to see the market absolutely load into call options, and the media as well proclaiming we're in a new bull market and everything's going higher, and retail positioning super bullish, as I showed you with the IG CFD accounts. Going back in history, they typically make for really good contrarian indicators, and it pays to be on the other side. Even though it's hard to do in the short term, you got to take a little bit of heat and moves against you. That's why I always do it with a balanced, diversified portfolio of longs and shorts. But like I said, I just increased my short tilt to 80% net short by adding Apple and Microsoft as new short positions and topping up my Royal Caribbean short, whilst also trimming my NVDA short and managing to scrape a little bit of profit off my last ad. So tomorrow should be interesting. Look out below if the Fed does do a surprise hike, which I think is a greater possibility than what the market is assigning. And if they don't hike tomorrow, they should likely hike in July. And even if they don't hike, like I said, we could still get a rug pull after OPEX this Friday afternoon. And that's how I'm playing it. Thanks again for sticking with me, and make sure you come back to the channel tomorrow afternoon, as it should be a real juicy one. Cheers guys, see you then.